what's your outlook for the real estate sector? Right now, everyone's all wrapped up in tariffs, so they're not even looking up at buildings.
Yeah, that's a good point. So we focus on a few sort of big themes. One, demand drivers and thematic demand drivers, the demographic theme in the US of the millennials, the boomers, innovation, e-commerce penetration continuing to grow, shifting globalization patterns keep happening, providing opportunity, and we have a housing shortage. You focus on those, the new supply is about down 50%, right? New construction starts aren't happening generally right now. So demand drivers solid, supply down, overall fundamentals pretty healthy. And then pricing has adjusted given the higher interest rate over the last 24 months. With regards to tariffs, lots of volatility, potentially focus on a real asset like real estate with those long-term demand drivers with right pricing. And we think there's actually an interesting opportunity today, and we're entering a new cycle.
And real estate is not monolithic. You have commercial, you have residential. So which area do you like? Because a lot of people thought not too long ago that commercial real estate was over. COVID was going to put big buildings out of business.
Yeah, there's a lot of big buildings right around here, right? So if you go to those demand drivers, it really pushes you towards the warehouse sector, right? Again, millennials entering their prime spending years, shifting globalization, manufacturing, investing provides opportunity, and that e-commerce penetration continues to grow. Housing, we haven't built enough houses since the global financial crisis. We're down 3 or 4 million units. So those sectors really tailwinds behind you. To your point about the challenges of commercial real estate in general, office still challenging, right? We have not recovered high vacancy rate, but if you follow the sectors, warehouses, housing, healthcare, we think there's opportunity.
Location, location, location?
Location, location, location. So then you get to that, the same themes drive you to, we like kind of next gen cities with diversified economies, relative affordability, and there's opportunity there too.
All right, so how do you run the CPREX? This is Clarion's fund that I think you run with Franklin Templeton. Tell me how you manage that.
Great question. So CPREX is the ticker symbol for Clarion Partners Real Estate Income Fund. The goal here is to provide access to private real estate for the individual investor. We've really innovated there, and really that's our goal. Real estate can have a nice, strong income component with some appreciation over time. We follow those sector themes that I just walked through, and of the total return, about 2/3 income, a third appreciation, and that's our goal. The fund is over $1 billion, and it can be much more easily accessed through a ticker and those type of things.
Can you talk about the income part of it? Because with the volatility in the market, income is cool again. You've seen the transfer from value to growth stocks. Talk about income.
So real estate's quite simple in that you own a property, you hopefully lease it to someone, they pay you rent. And unlike a bond where you invest in a bond, you get an annual principal payment, the goal with real estate is to be able to increase that over time, right? And that's where the inflation hedge part comes from real estate as well. So the income component is a strong piece of our investment thesis. We try to curate a portfolio of diversified properties with different income streams based on those sector themes I spoke about. But again, you get income today with the leases in place. And then if you have those thematic demand drivers behind you, you can actually grow that income as opposed to a steady income like a bond, which again hedges against inflation.
And then finally, can you talk about private markets and investing in buildings that are owned not in REITs but privately? Because that's another big trend we've seen in the market of late. Private credit, private markets, as opposed to going into a publicly traded REIT. What are your feelings on that?
So the private markets are huge, much larger than the public markets. So there's a large opportunity here. And fortunately, there's been a lot of technological changes recently, just given the ability to value assets in a much more efficient manner. The regulations behind these types of funds, our relationship with Franklin Templeton, they're our partner here. So you bring all these together, product has changed. There's a large investable universe here in the private markets, and we charge one sort of flat fee, and we think of creating a diversified, curated portfolio of properties across the country, versus a publicly traded REIT can be a great business, but it becomes an operating business sort of focused on one sector in one location. So I think they're quite different, and you tend to have much more stability, lower correlations, low volatility, and can be kind of a strategic part of a portfolio because of the private markets.
And your fund is still liquid because it's a mutual fund. You're not held into a quarterly payment.
Actually, it's a quarterly tender fund. So it's a daily ticker in with a quarterly tender with a 5% per quarter liquidity. We are trying to manage that the illiquidity premium, right? So you're buying properties, they're not highly liquid. We have a liquidity sleeve and we manage to that 5% per quarter or 20% per year.
All right, well, thanks for coming on and talking about it.
Thank you so much, Greg. Appreciate it.